Okay, welcome, ladies and gentlemen, to this class that we shall be doing today, which is sort of a revision, although there will be some few new concepts for those who are writing tomorrow. But I can say for those who are doing MAC3701, it can also help you so that you can revisit some concepts that you have done, and then there will be one or two concepts that we have not yet done. I'll try to explain them in a way that will be able to understand them. Right, our session will start now. Then around 12:15 or half 12, I'll give you a 10-minute to 15-minute break. Then we'll resume. Then we continue up to around 2, half 2. So we'll finish between 2 and half 2, whatever we have done by that time. Then we'll be able to finish, because I also have my other guys who are writing text during the week. So I still have to meet them later on. Right. This, as you will see, that it will be past paper based. So the issue is about understanding the concepts that will be involved. I've sent 2 papers. After we've done with this, you can try to also use the other one to see if you can apply some of the concepts that we'll have covered as we go. Right, so as I said, we'll be using the January 2022 paper. Very sorry for the delays. I was having an earlier class which was unfortunately affected by load shedding, so it had to protrude. We're supposed to start at 10, but we ended up postponing to half 10. Very sorry for that. Right, so let's start. Right, Pelindaba is a vertically integrated company with business interests in grains and moringa farming and milling and maheu production. The company is a head office and 2 divisions which are managed by independent management teams, namely the farm division and the maheu division. The management team of each division receives a performance-related bonus if their division achieves a return on investment of 50% or above for the particular financial year. Right, if before you even answer your question, please pay particular attention to these, some of these things that will come here in the first paragraph. You would find that you might have questions at the end of the day which might need these things. So you should already note that they can only get a bonus if they attain a return on investment of 15% or above. So you should mark that and understand that. Right. Peli uses absorption costing system for internal reporting purposes. Values all its inventory items using the first in, first out method, and there's a 31 December financial year end. These are very, very, very important things. We know that if they are using absorption costing, it means in product cost, we include both production and both variable and fixed production costs in valuing our inventory and our cost of production. Unlike direct costing, whereby we only include variable production cost. And when we say first in, first out, it means our closing inventory is made up entirely of goods that were produced during the current period. As such, our closing inventory will be measured based on the current period's cost structure. The opposite is the weighted average method, whereby to find our closing inventory, we have to find the weighted cost of the opening inventory and the current production cost for us to determine the cost of our closing inventory. So in this case, we know that our closing inventory will be exclusively calculated based on the cost structure for this year. So you should mark that and know those things. Right, let's go to the required. Then you don't have to read everything else. Otherwise, time might destroy you. Right. Comment on whether the management team of the farm division will receive performance-related bonuses or not for the 2021 financial year. Support your comment with relevant and applicable calculations. So already we know that they can only get a bonus if their return on investment is more than 15%, 15% or more. So in other ways, on this question, they are saying calculate, to rephrase this question, it's calculate the return on investment. If that return on investment is 15% or more, the management team should get bonuses. So you would calculate, after calculating, then you comment. Right. So let's go back and okay, let me just go to my right? So in this case, we'll calculate our return on investment. All right. What's the formula of our return on investment first? For us to know what we are calculating here. So it's one of the things that we have not looked at. Right, to calculate your return on investment is the controllable profit multiplied by 100 over the controllable investment. Right. What is our controllable profit? Revenue minus controllable costs. Right. When a division operates, when we are talking about controllable costs, we mean those costs that are affected by the decisions made by local management of the division. So we don't subtract all those costs that they don't have control of. For example, head office allocated costs. For example, if you are renting a building and management do not have a choice on choosing where to rent, it's head office who makes decisions. That rent will be uncontrollable. So when we're assessing the division, we won't include that rent as part of the expenses. So when we talk about controllable costs, we mean those costs for which management can be able to affect. That means they can cause them to go up or go down through their decision making. So we don't include all those items that management cannot affect, which are usually done by head office, which they don't have control over. Right. So we'll be trying to judge a manager based on those things that are affected by his decisions. It's unfair to say that we are judging you based on decisions that were made by head office. So we have to judge you on those decisions that you actually made as a manager. So as a result, that's why they calculated this what we call controllable profit. So we don't subtract. It's unlike now the normal way of calculating our profit. We're saying in this calculation of profit, we don't include anything that is not affected by the decisions by management. So they will normally tell you those things within the passage, as we shall see. Then controllable investment. Would be equal to controllable assets minus controllable liabilities. So again, we only include the assets and liabilities which are affected by the decisions made by management. For example, if the head office is responsible for buying all PPE items, then the PPE will not be included within our controllable investment. If the head office is responsible for working capital decisions, then our current assets and our current liabilities will not be included in the controllable investment. So you'll find that in your passage, in your questions, they will actually tell you those expenses and incomes that are being affected by the decisions made by the particular division managers. Right. So let's read and see what we can get. Remember also that in your questions they might have 3 or 4 divisions, but here we're question A to C were relating to the farm division. So question A to C were on the farm division. So let's go to the farm division and hear what they are saying here. Right. The farm division. The division is responsible for the production of moringa, maize, and other grains on the company's 200 hectares farm. Near Brits. Moringa is planted on 100 hectares. Maize is planted on 80 hectares. Other grains are planted on 15 hectares. And the remaining hectares are used for buildings and equipment. Actual results for the 2021 financial year. The financially, also you should check your year. We are told that we should talk about the 2021. So we're talking about 2021. That's the year that we're talking about. So that's where we are going to get our answer here. The financial manager submitted to you the performance analysis, which indicates that the farm division achieved a residual income of 300,000. Upon further investigation and the related inquiries, you identified that head office allocated costs of 200,000 were deducted from the gross profit amount to arrive at the controllable profit used in the residual income calculation. The cost of capital for the year was 5%. Controllable assets were 15 million and controllable liabilities were 5 million. Right. We need the controllable profit and the controllable investment in our formula. If you can see here, we need, for us to calculate this, we need the controllable profit and the controllable investment. Right. In this particular question, the controllable investment can be readily calculated. We say it is controllable assets minus controllable liabilities, and we are given these things. The controllable assets and the controllable liabilities are given here. So it's 15 million minus 5 million. So we can say 15 million minus 5 million, which is equal to 10 million. That's our controllable investment. So we now need our controllable profit. Right? They've introduced one variable that I didn't talk about, which can help us here. We are not given the revenue. We are not given the controllable costs, but we are given what they call residual income. Residual income is another parameter that can be used in judging the performance of the department. So you can even be asked to calculate the residual income. Now, what is residual income? The residual income is equal to controllable profit minus cost of controllable investments. And one thing that I know is that you guys were very good in mathematics. So, okay, let me just first start with the line of thinking. If you are looking for something, and we know that controllable profit is revenue minus controllable cost, but we are not given that revenue, we are not given the controllable cost, and there's no way that we can get them. We have to find what is given, which also includes that which you are looking for. You look at what is given, of which its calculation or its determination also includes what you are looking for. So that's what led me to know that, okay, we are given the residual income, but I know that my residual income is controllable profit minus cost of controllable investment. Through that, that's when I knew that I should use that residual income to find my controllable profit. Right. Now, I can change the subject of the formula because the residual income, I have it, but what I'm looking for is the controllable profit. So we can say our controllable profit, if I change the subject of the formula, it would be equal to the residual income
plus profit.
As what?
Controllable profit.
Cost of controllable investment. So I can do my calculation here basically. So I can say, I just changed the subject to the formula there. My residual income right, I'm given my residual income here, right, my friends? My residual income is given here, 300,000. Then the cost of capital for the year was 5%. We use the cost of capital to find our cost of controllable investment. I will show you just now. Right, so our residual income okay, sorry. Right. Our residual income is 300,000. Cost of controllable investment to get your cost of controllable investment is equal to cost of capital or required return. They can give you it as a required return. Multiply by what? The controllable investment. We know the controllable investment. Our controllable investment, we calculated it here, is 10%. And if our required return is what? Is 5%. So we simply say %5 times 10 million. What do we get? Thank you, guys. 500,000. Right. Then we then say, but this was supposed to be our controllable profit, but we're told something that a head office allocated cost of 200,000 were deducted from the gross profit amount to arrive at the controllable profit used in the residual income calculation. So that when they use that controllable profit, they included head office allocated costs, which is wrong. Head office allocated costs are not controllable costs, so we have to add them back. So here we're correcting an error now. Then we say head office allocated costs. Remember, I said when you are calculating your controllable investment, you don't include those costs that are not controllable. Head office allocated costs are costs incurred at head office, which are simply allocated to the various departments. So this should give us our controllable profits. This is our controllable profit. So that means now at the end of the day, our return on investment, we can now calculate it since we now have both the controllable profit and the controllable investment. From my formula that I gave you up there, we know that a return on investment is controllable profit times 100 over controllable investment. Right? Our controllable profit is 1 million times 100 divided by the controllable investment, which is 10 million. Right, what do we get?
Please repeat that part about the head office allocated cost. Why are we adding it back?
Because it was not supposed to be included in the calculation of controllable investment. They said that it was when they calculated that a controllable profit, which they used, they had deducted the head office allocated costs, of which head office allocated costs are not controllable costs. They should not be included in the calculation of the controllable profit. Remember, I said controllable profit is revenue minus controllable costs. So all those costs that cannot be controlled by the particular division's management should not be included in the calculation.
Should not be included. Okay.
Yes. So it was wrong to include them. So when you include an expense, remember you subtract. So that means by including them, they subtract.
You add it back.
So to reverse, you have to add back.
Okay, cool. Thank you.
So you should always remember that when reversing an expense, we add back. Okay. Whenever we're removing an expense that was included wrongly, we add back.
All right. Thank you.
Thank you. Okay. Thank you, guys. I see there's 10% and will not get bonus. Very good conclusion. Right. So the answer is 10%. But remember, they were supposed to get a bonus if the return on investment was 15% or more. Is that right? That was according to so we're saying the management team, don't forget to put your conclusion. You will not get a bonus, considering that the return on investment achieved of 10% is less than the target of 15%. So don't forget on such type of question to also give a comment, because there will be marks on the comment. Right, any questions, my learned colleagues? Okay, thank you so much. So we'll move on if we don't have any questions. Right, let's go to the next question. Identify and discuss 5 business-related risks that the farm division will potentially be exposed to during the 2022 financial year. Right. Normally, when you are asked about the risks, you start with those that are evident from the scenario. But if they are not enough, then you can also use your general knowledge. That you already know that in the farming division, farms highly depend on rainfall. They can be a drought. Already you know that in your mind, you're already answering that. They can be power failures, which might make our irrigation equipment not to work as expected. Already you have that. But first of all, before you conclude, go and read that farm division and see all those risks that can be there. Right. So let's go and check our farm division. But we know that they want 5, so don't write 10, you won't get extra marks. They said what? It's for what? For the 2022 financial, for the 2022. So we have to read the circumstances under 2022. All right. Now, under the 2022 budget, for the 2022 financial year, during the 2022 budget and production planning meeting, the farm manager raised concerns about the recent heavy rainfalls and thunderstorms on the farm, as well as across other South African regions from which some of the production units are procured. Furthermore, the financial manager presented the following information that relates to the production and milling of moringa. Right, so let's already we have that business risk name. Business risks. So we're saying adverse weather conditions. May negatively affect the youth. It can be here, they're talking about heavy rains. So these heavy rains, remember that crops need different types of different quantities of rain. So if there is heavy rainfall, there might be some plants which might not need that heavy rainfall, which may negatively affect you. Right, yes, I understand load shedding is there. I was saying that first of all, we're going to come to all those things, but first of all, let's see if there's anything that is particularly stated on the question. Right, let me just quickly check. You can be checking also so that we don't waste our time. Okay, maybe let's just read so that we can also be conversant of what is on the passage, so that when we do the next part, we won't read. Right, the farm's production budget was prepared based on the planted 100 hectares, and the related yield is 100 kilograms per 0.25 hectare. The losses incurred are considered immaterial. The farm has a total annual external demand of 30,000 kgs of moringa powder. It is also required to transfer moringa powder to the Maheu division in each financial year. Right. There is a possibility that market conditions may not make it possible get the expected demand. Or maybe in short, we're saying the demand might be lower than what we expect after all. There can be competition, or maybe there can be a decrease in the disposable incomes of the people, which might, there can be substitute products and stuff like that. Right. Then the direct costs of field preparation and harvesting are 110 per kg. The harvested yield is further processed into moringa powder at a cost of 10 cents per kg. The variable production overheads are budgeted for at 20 per hour, and it takes 45 minutes to produce 1 kg of moringa powder. The fixed production overhead absorption rate is 12 rand per kg of moringa powder. As part of the production process, external sales units are packaged at a cost of 9 rand per kg. Units sold internally are not packaged. The distribution manager noted with concern the increased risk of the division's delivery trucks used for external customers' deliveries only being charged in line with such incidents taking place throughout the country. So there's a risk that some of the trucks may be charged. Is that right? There is a risk that delivery trucks may be charged, resulting in loss of life, tax, and injuries. Right. Then the budgeted external selling price is 600 per kg, and the related variable external selling costs amount to 1% of the budgeted selling price per kg. The Competition Commission of South Africa notified Peli of its pending investigation into the alleged charging of an excessive price per kg of moringa powder. Along with other natural remedies, moringa is thought to assist with fighting COVID-19 symptoms. If found guilty, Peli will have to pay a penalty of 200,000. Right. The penalty imposed may adversely affect the liquidity and solvency of the division, which can lead to going concern issues. If we are given a hefty penalty, and maybe it has to be paid as fast as possible, that means we'll have a huge cash outflow that can be able to adversely affect our operations. Tobile.
Yes, Eugene. I'm noting that as you are raising these risks, you also look into the consequences, of which I think it's more of a critical part. When you raise the risk, you also look at the worst case scenario. I'm looking at risk number.
Like when they ask you about the risk, it's usually important. If you can see those marks are 10. So if you just they say identify and briefly discuss the related risks that the farm division will potentially be exposed to. So if it's 10 marks, if I just list, I might get 5 marks then. Does that answer you? Tovile, are you still there? I think the person is not there. Right. So, but generally, if you see my question, our question here needs 5 risks, and they say identify and in bold briefly discuss. And then there's what? 10 marks. So that we don't just list there, because there's a risk that you can just get 5 marks for just identifying them. Right, number 129. The financial manager also made the following comment. Some of our main external customers are lagging behind with their monthly payments and are struggling to adhere to the granted credit terms of 30 days from invoice date. Some have cited their own customers' slow payments and challenges with the distribution of their products due to fluctuating COVID-19 infections that impact employees' work attendance. Despite these cited challenges and issues, the monthly orders of these customers of ours did not change. So they continue to buy and delaying. So there's a risk of burdens. There is a risk that some customers may fail to pay. Or will excessively delay. Which can lead to liquidity challenges. Remember that you depend on your customers to pay so that you can settle your issues. Let's say, for example, you are not working, and the only source of money that you are expecting this month is your cousin. You gave the cousin 5,000, so they are supposed to pay you. They said they will pay when they get paid this month, and your landlord needs 3,000 for rent by the 1st of June. You pay on the 1st, and normally your landlord does not give grace period. So even if your cousin gives you next month, but for now you are in a crisis. So that's the same like in a business scenario. When we don't get cash when we expect it, remember we budget and plan. Normally we expect that in a month our debtors will pay so much, and with that we can be able to settle so much. So now if that does not happen, that can lead to a crisis. Right. So those were some of the reasons that are evident. So please start from what is evident on the scenario. Then on, you can go on further now and talk about, you can talk about like there's a sister who talked about load shedding, that there's serious load shedding in SA. And most of the machinery, plant and machinery that will be working in the farms, it needs power. So there's a high risk of load shedding. Again, Palisa is giving a very good point. The reputation of the company can be damaged because of this pending investigation. That one is specific to the scenario that we have, which may lead to the company losing key staff and customers. Right. So all those reasons you can go on and on, but for the sake of time, we will not go on and on. So actually, this question, like business risk, it's a question that I expect all of you to be able to answer. But as I'm advising you, please start by looking at what is on the scenario. And if you see that my points are not enough, link your, like here they specified that 5. Sometimes they don't specify. You look at the marks. And if you see that they say identify and briefly discuss and it's in bold, most probably that means already even if they didn't say 5 reasons, already I know that maybe there's a possibility that there can be 2 marks for each part. Right. Tobile, yes. I was saying the question has got 10 marks, and the question says identify and briefly discuss. So through that, that's why we're trying to at least expand. Because otherwise, if you just list the risk, you only get 5 marks.
Yeah, no, I that you, okay. I was saying on risk number 2. Yeah, I was saying on risk number 2, where we say there is a possibility that market conditions may not make it possible to get the expected demand. I was going to say maybe if we can beef up that risk to say resulting in loss of customer loyalty, since we are not being able to meet the demand of our customers.
So, like that can be a separate point. My point here is saying that demand that we're expecting may be less. That second point is talking about our demand can be less. So that one can also be a different point, that maybe due to production difficulties, we might fail to deliver to our market, which can result in loss of customer loyalty. That's a very good point, but that can be separate from that one. That number 2, I'm talking about the market conditions, like that demand that we're expecting 30,000. We might find that due to competition, instead of getting the 30, we get 20. So your point is very good, but it can be a separate one.
Yeah, got it. I got it. I thought we
yes, on that one I was saying that our demand is not what we expect. We have the capacity, we can supply, but we don't have the demand. That's the number 2 point. So that one you can put it as a separate point now. And it's also correct. In other contributions here. So there are many things that we can write here. So those are some of the questions that if you're in an exam, quickly answer them before time passes. Because you know definitely you won't fail to get reasons here. Right. So let's move on. Number C. Based on the farm division's 2022 financial year budget information, assume that the Makeo division required 12,000 kgs of moringa powder during the 2022 financial year. Advise the farm division's management team of the minimum transfer price per kg of moringa powder that they can accept for the transfer of the required kgs. Right, this is transfer pricing. Right, it can happen that one company can have various companies or divisions that are doing different things. For example, you might have a division that is running forests and produce wood, and then maybe they process that wood so that it can be sellable. Then you have another division that is manufacturing furniture, which needs wood. So at the end of the day, we might have the division that is producing wood, supplying part of its wood to the company that is producing furniture. But remember our brothers and sisters. So you'd find that usually there can be a special price, which is different to that which is offered to the market. Right. So that's where minimum transfer price and maximum transfer price come in. Right. Minimum transfer price. So please, some of these notes that I write, if you're in an exam scenario, you don't have to write them. Is that right? I just need to explain. Right. The selling division would determine the minimum transfer price. When we say the minimum transfer price, that is the lowest acceptable price that they can accept if they are being they'll be selling to their brothers. Right. Now the minimum transfer price is the unavoidable production and supply costs plus lost contribution per unit. External sales sacrificed. Right, you would find that the division that is selling, it has two options. Like the farming division in this case, they have two options. They can sell to the external market, or they can sell to the Makeo division. Right. Now, if the needs of the Makeo division will make me fail to meet my demand of the external market, then the Makeo division should also compensate me for the lost contribution. Remember, I was supposed to get something by supplying externally. So if I'm going to fail to supply externally, you guys have to compensate me for the contribution that I've lost. So my minimum price would be the unavoidable cost that I will have to incur in the production process, because I will definitely incur them. You have to give me my cost. I can't suffer that cost. Then on top of that, if there is any contribution that I lose outside, then you have to compensate me. Right. So now, normally the unavoidable costs are usually the variable costs. But we can also include fixed costs if they say they can be avoided if we don't supply internally. Right. So now here, in our case, let's determine the variable production cost that will be incurred in producing if we are supplying internally. We are told that if we start here, the farm's production budget was prepared based on the planted 100 hectares and the related yield is 100 kilograms per hectare, per 0.25 hectares. The losses incurred are considered immaterial. Right, let's first determine the variable because the farm has a total annual external demand of 30,000 kgs of moringa powder. So when they say external demand, that means before, without supplying Maheu, they already have a market for 30,000 kgs. Then Maheu now wants 12,000. Right, I'm going to come to that very soon. The direct cost of field preparation, pesticides, and harvesting are 110 per kg. So they have to be what? These are direct costs. That means if we are going to supply you, you have to compensate us. Then, right, so they have direct cost of field preparation. Field preparation. Pesticides and harvesting. $110. Then we have the harvested yield is further processed into moringa at a cost of 10 rand per gram. We should be very careful. This is per gram. So we have to convert it to per kg. So further processing. So you should be very observant when you're doing your exam. So 0.10, this is per gram. So we have to convert it to a per kgs, then we multiply by 1,000. What do we get? I think that would be 100. Right. I multiplied by 1,000 because it's given per gram. Right. So to per kg to be multiplied by 1,000. The variable production overheads are budgeted for 820 per hour and it takes 45 machine minutes to produce 1 kg. So that those minutes should be converted to an hour. Variable production overheads. This is 20 times 45. I will divide by 60 to convert it to hours. What do we get? Thank you. 15. Fixed production overheads, we don't we don't include fixed production overheads because why? We are saying they are irrelevant because whether we supply internally or externally, they will just be incurred at the same rate. Right, as part of number 1.27, so you don't include fixed costs. As part of the production process, external sales units are packaged at a cost of 9 rand per kg. Units sold internally are not packaged. Right, so we won't charge them because remember we're not packaging for this, so we're trying to find the internal selling price. So any costs that are only incurred if we supply externally, we don't include them. So we will not include in the minimum transfer price any costs that are only incurred if we supply externally. Why? Because the internal supply will not incur such costs. We won't need those costs. Budgeted external selling price is 600 per kg and the related variable external selling costs are 1%. All those are external costs. Right. I think that's it. Then now we have to find if there's any lost contribution. So these are the costs that will definitely incur if we have to produce for a Maheu. We'll definitely have to pay the direct cost of 110. We'll definitely have to do further processing of 100. We'll definitely have to pay variable production cost of 15 for us to supply to them. Right, then the next thing, remember I said it's unavoidable production cost plus lost contribution. Right, the fixed costs we ignore them because whether we supply externally, even if we don't even supply, remember that fixed costs are costs that do not change. as production levels change. So even if we don't supply internally, we'll still incur those production fixed costs. Right. Now, for you to check if there's lost contribution, we have to compare the capacity and the requirements that are needed. Right. Let's calculate the capacity. Right. The capacity, we know that they want to plant a 100 hectares. And after planting those 100 hectares, they will yield 100 kilograms per 0.25 hectare. 100 kilograms per 0.25 hectare. So for us to be able to find the number of hectares, the capacity, we can say 100 multiplied by 100 divided by 0.25. What do we get? Because the 0.25 every 0.25 hectare will give us 100 kilograms. So to find the total number of kilograms in the 100 hectares, we have to say the first 100 is the 100 kgs that they're getting. The second 100 is the 100 hectares. Then we divide by 0.25. 40,000. So that means they are going to get 40,000 kgs. So these are the kgs that they are expecting to get. Right. So now if we can say our capacity is 40,000. External demand is 30,000. Remember, we were told that externally we're expecting 30,000. The farm is a total annual external demand of 30. So that means our excess capacity, what we call excess capacity, our excess
Can we pick
capacity.
the available capacity as well?
I can't hear you.
Can we put down available capacity as well?
Yes, yes. So that is the available capacity. That's very correct. So we have 10,000 units that we can produce for Makeo without affecting our external demand. That's what we're saying here. Is that right? Thank you, TK. Right. So we have got 10,000 units that we can supply. But now Makeo does not want 10,000. Makeo wants 12,000. Makeo requirements is 12,000. So we have a shortfall here of what? 2,000. So we have a shortage of 2,000 units here for us to be able to satisfy both our external demand and the Makeo. So how do we solve that? If we have to remember that usually the organization's objective says a whole will supersede the needs of the various divisions. So you'd find that we have to satisfy our sister company Makeo with the 12,000. And for us to be able to do that, we have to cut demand on our external market by 2,000. So if we cut that demand, we have to find our lost contribution. Lost contribution, we are going to lose our contribution which we're getting from 2,000 units sacrificed on external sales to fulfill Makeo division requirements. So we now have to sacrifice that. Our external market, we give them 28. Makeo, we give them 12. Then our 40 will be enough. So the other 2,000 external customers are going to sacrifice them. They will get nothing. So we have to find what is the contribution that we'll be losing. Yes, that's 2,000 kgs. That's correct. Is that this is 2,000? Monique, this is 2,000. Yes.
Yes, but is it fine if you say units?
It's kgs here.
Yeah, but the sentence says
Oh,
units.
you mean here?
Shouldn't it
Yeah,
say
okay, okay.
kilograms?
Okay. Right. So these 2,000 kgs will be sacrificed. Right. So we have to find out how much contribution will be lost. Right. Contribution, remember, it's a selling price less variable cost. So you say selling price. Right. We are told that the selling price to the external market is 600 per kg. So it's 600 less variable cost for that external demand. Remember, our variable cost, they start from this. But the external market also has additional costs, variable costs. Remember, there are those variable costs that we left out, that there's a packaging of 9% 9 rand per kg for the external sales units. So there's packaging. R9. Then also there was something also that I read. Okay, when they sell the budgeted external selling price is 600, and the related variable external selling cost is 1%. Variable external selling cost 1% multiplied by 600. I guess that will give us 6. Then we total to find our total variable cost. Contribution per unit. Right. So that means externally we're getting a 360 rand per kg. So this is our contribution per kg. So we're getting 360 if we sell externally. All right. So our total lost contribution, if we have to give by all the required units, we'll have to lose. What do we get?
$720,000.
20,000.
Right. So that means, thank you guys. If we cut 2,000 units from the external market in order to satisfy Maheo, we are going to lose 720. So for that to happen, for us to be judged, remember that when we are judged our performance, they will judge it based on our profitability and stuff like that. So if we are going to lose this 720, that has to be compensated by Makeo in their order. So they have to compensate us. The loss contribution will be 720,000. We'll allocate them on the special order that they want, which is 12,000 units. Remember, they want 12,000 units. What do we get?
60.
60. So that means they will have to compensate us our minimum transfer price.
Mr. Eugene,
Yes,
where are we getting the 12,000 units?
they are on the question.
Okay.
That the Makeo division requires 12,000 kgs. Yeah.
Thank you.
Right. So then the minimum transfer price would be equal to 285. So when we are charging the Makeo division, we'll tell them that we sell externally 600, but the minimum that we can charge you is 285. Because that minimum will leave us in the same position that we are, even if we satisfy all our external market. Our performance will still be okay. That's the minimum. If you want a price which is less than 285, we can't supply you. So that's how we calculate the minimum transfer price. So you take the unavoidable variable cost, then you add any lost contribution. That is if they are external sales to be sacrificed. So if our capacity was, let's say 50,000, there was no need to calculate the lost contribution because we could satisfy Makeo and also our external demand without any problems. So the lost contribution only comes into play if our capacity is not enough to satisfy both the external and internal requirements. That's when we have to talk about the lost contribution. If our capacity is enough, then there's no problem. We'll just include the variable production costs that have to be included when supplying internally. Any questions? Right. They can also ask you to calculate the maximum transfer price. Maximum transfer price is for the buyer. The buyer determines the maximum. All right, because you will say I buy, like let's say Makeo, maybe they are already buying this product from somewhere else externally. Now, if they are buying, let's say for 300 rand, and they have to pay delivery cost of 20 rand, so they are spending 320 to buy the goods. So if the farm division charges anything more than 320, then they will say no, we cannot accept that. So for the buyer, the maximum price is the price that they are acquiring, the variable cost that they are incurring for buying outside, the cost per unit for buying outside.
But they don't ask that often, sir.
They do.
I haven't seen it in one of the market.
You can have a question with the maximum and the minimum.
Oh, I haven't seen one in the mock exam. That's what I was wondering.
It has been there, but of course they've like it that like why? Because usually it doesn't have many calculations that one. Because usually when it comes, it's 4 or 5 marks. But that's why I'm just trying. It's not about like usually I try to tell you everything so that if it comes, you are also safe. That's why I have to tell you. Is that right? So I think the maximum transfer price, you simply have to check the buying division. What is it that they are incurring by buying from outside? Then that will be their maximum, the total cost that they're incurring by buying from outside.
No, I was going to ask the same thing. You repeated now. It's fine.
Okay, thank you so much. Right, so that's our minimum transfer price. No. This one you just have to calculate the minimum transfer price. So you can just write that the minimum price should be, maybe you can just write that the minimum price should be that figure that we calculated. Right. Number 2. Refer to the financial manager's comment in 12.1.29 and identify and briefly discuss 2 ways to manage raised challenges with its main external customers. So it's referring to a specific party. Yeah? I think we read that, I think about credit losses. The financial manager also made the following comment. Some of our main customers are lagging behind with their monthly payments and are struggling to adhere to the granted credit terms of 30 days from invoice dates. Some have cited their own customers' slow payments and challenges with the distribution of their products due to fluctuating COVID-19 infections that impact employees' work attendance. Despite these cited challenges and issues, the monthly orders of these customers of ours did not change. Right. They said 2 ways that we can use. I can just call it credit management. They can introduce early payment discounts. Some customers will be attracted by this for paying within a predetermined period. This will attract some debtors. And they may end up reducing the payment period. Right. You can also introduce interest on overdue payments so that customers may avoid delaying payments to avoid interest. I'll just stick to 2. You can even talk about vetting of customers. You can talk about follow-up, because these customers, their orders have not changed. That means their business is still booming. They are still buying the same quantities, but what they are just delaying is the payment. So that means they are still operating. So you can also look at things like vetting of customers before granting credit. You can also talk about following up on long outstanding debts. So there can be many things that you can do there. Any questions? So please, on such questions, what I'm saying is that's not the entire answer. There are many things that you can write there. But for the sake of time, we're not going further. But you just have to give 2 if you're in the exam, like what I've done here. You don't have to go on and write 10. You won't get extra marks. But if they say 2 and they say briefly discuss, don't just write that introduce discount. Charge interest. There are 4 marks, you just get 2. They said identify and briefly discuss. Right. And they specified that 2 methods. Right. Next question. Right. You should be very careful. That means question A to C, that's farm division. Now D to I, you are now on the Machel division. Right. Number D, calculate the budgeted margin of safety in percentage terms for the Moringa flavored product type for the 2021 financial year. Ignore the implications of opening and closing inventory. Right. A margin of safety refers to the extent to which our budgeted or actual sales can drop before we start making a loss. Right. So we're going to say, for you to calculate your margin of safety, normally you have to first calculate your break even, and you should be very careful. They said for the 2021 financial year here, so we should deal with the 2021 financial year. The Macau division. The division is responsible for the production and selling of two Macau flavors, which are banana flavored and Moringa flavored. The division recently received heavy criticism from social movement organizations for employing underage immigrants and paying them at a rate that is well below the minimum prescribed wage for the industry. Extracts from the budgeted and actual results for the year ended 31 December 2011. The division did not budget for opening and or closing inventory of any type. The actual opening finished goods inventory units as at 1 January 2021 consisted of 1,200 units of BF and 600 units of MR. These units were valued at 10 Rand per unit of BF and 14 Rand per unit of MR. There were no other types of actual opening inventory. Remember, this part of the question, they said we should ignore the impact of opening and closing inventory. Right. The divisions budgeted. So, okay. First of all, whilst you are shaping your answer, whilst you are reading there, you should note that we need the margin of safety. Right. And for you to calculate your margin of safety percentage, so normally you should start your analysis from what you are required to calculate, because it is the one that you that will be what will guide you in understanding what you need to look for. Right. So your margin of safety is equal to, remember we're talking about the budgeted sales minus break-even sales multiplied by 100 over the budgeted sales. That's what we're looking for. So that's what we're looking for. So you should check if you are given your break even. If not, then we have to calculate. You should check if you are given your budgeted sales. Remember, the question is calculate the budgeted margin of safety. That's why I'm talking about budget. If they said actual, we're going to say actual sales. You should be very careful, as I said in your exams, whether they're asking about the budgeted or actual. Right. The division's budgeted in actual production was 258,800 of BF and 129,400 units of MR. These units are equivalent to the division's normal operating capacity. Right, we're not worried about that production, we want the sales. When you're calculating break-even, you're interested in the sales. The actual units sold were 259,000 of BF and 129. We're not interested in that. Right, okay. I think this one will be interested in it because of one thing. First statement. The division did not budget for opening and closing inventory of any type. That means the budget does not have opening inventory and it does not have closing inventory. Now, if your budget does not have opening and closing inventory, that automatically means that production and sales are equal. As long as there is no opening and closing inventory, it means our production and sales are equal. So that means this budgeted production of 258,800 and 129,400. So that is our what? Our budgeted sales. So that can also give us what we need, what we call the sales mix. Remember, when we calculate our break even, we need the sales mix. So our sales mix is equal to so we're supposed to look for the actual sales, but the budgeted sales, sorry, but the fact that they said there's no stock, as long as they give us production, you know, that's automatically also your what? Your sales. 258,800 S2 129,400. And if I simplify, I think that gives me, is it 2:1? If I divide those two. Thank you, man. That's correct. 2:1. Our 2:1 is simply coming from 258,800 divided by 129,400. Usually it will be easier for you to calculate if you simplify. You can leave it like that as what 258,800 is to 129,400. But your calculations might be less complicated if you reduce it to the to its lowest form. So that means their sales mix is 2:1. We'll need it later. Right. Then we know that, okay, another thing, we know that to calculate your break-even point, units, you can even use as amount. This break-even, it's a budgeted total fixed cost over weighted contribution per unit. So already in your mind, you should know that I need the fixed cost, I need the weighted contribution, so that I can determine my break-even, which will help me determine my margin of safety, which they're asking for. Right. Then the primary ingredients, number 2.15, used in the production of both BF and MR are the same: maize, sorghum, and water. The budgeted combined cost of the aforementioned ingredients are R1 per unit, whereas the actual combined costs were 10% higher than budgeted costs. Here we're only interested in the budgeted. The budgeted and actual usage quantities were the same at 0.0 kg per unit. Right. The secondary ingredients for BF are banana and preservatives. The related budgeted and actual costs are R2 per unit. The budgeted and actual usage per unit were the same. Right. Then the secondary ingredient of MR is moringa powder. The budgeted and actual usage of the moringa powder per unit of MR was 10 grams and 12 grams respectively. The division budgeted and actually purchased moringa powder at 300 rand per kg. Right. We should know that we're only interested in the what? Budgeted. Both BF and MR require packaging in the form of hardboard, box, paper, and plastic containers as part of the production process at a budgeted cost of R150 per unit. The actual cost was R160 per unit. Direct laborers are employed to work in the production process at a budgeted rate of 38 per direct labor clock hour. It takes 6 direct labor clock minutes to produce 1 unit of BF and 9 direct labor clock minutes to produce 1 unit of MR. And the allowed idle time was 5%. The actual rate per direct labor clock hour was 36. The actual direct labor clock minutes per unit was equal to the budgeted direct labor clock minutes for both product types, and the actual idle time was 8%. You see, well, I'm just trying to read what is there so that we can be able to have a picture of the costs that we have. The budgeted and actual variable production overheads was 0.56 per unit of BF and 0.62 per unit of MR. The fixed production absorption rate per unit was 150, and the resultant over or under absorbed amount is treated as period cost. FPO absorbed based on production units. The actual fixed production overheads that relate to BF were 400,000. Right. The budgeted and actual selling price was 14 per BF and 18 per MR. The budgeted variable selling cost per unit for both product types was 1% of the selling price, whereas the actual variable selling cost per unit were 1.5% of the selling price. The total budgeted fixed administration costs for the financial year were 1,417,700 common fixed costs. Right. So let's be together now to calculate these things. Let's calculate first our total fixed cost. Right. Our total fixed cost. We have a fixed production overhead. Right. We are told that our fixed overhead, there's an absorption rate of 150. Remember that an absorption rate is prepared according to the budget, of which we know that our budget production is 258 and 129,400. So we simply have to multiply that rate of 150 per unit times the number of units. We simply have to multiply the 150 per unit times the number of units. All right. So would say 150 multiplied by 258,800 plus 129,400. What do we get? $582,300. Right. Then we are also told the other fixed costs that were given. We are also given the fixed administrative costs. Which were given that they are given here on 2.114, 1417700. This will give us our total fixed cost. So we now have our numerator here. The next thing is to calculate our weighted contribution per unit. For you to calculate your weighted contribution, first of all, you have to calculate the contribution for the separate products. Right. We have got BF, MR. Selling price. Our selling price, the budgeted and actual selling price was 14 and 18. Less variable cost. Right. The primary ingredients for in the production of both BF and are the same size, same maize, sorghum, water. The budgeted combined cost of the aforementioned ingredients were R1 per unit. So it was R1 per unit. We're not worried about the actual. So we say primary ingredients. Right. Then the secondary ingredients for BF are banana preservatives. The related product budgeted and actual costs are R2 per unit. Secondary ingredients. Then
So that's the secondary ingredient only for BF, not for
it's
MR.
BF. Sorry about that. Thank you so much. Then the secondary ingredient of MR is moringa powder. The budgeted in actual usage of moringa powder per unit was 10 grams and 12 grams. Or we are not interested in the 12. We only want the budgeted is 10. The division budgeted and actually purchased at 300 per kg. Remember, these are 10 grams. These ones are 300 per kg. So to get that, for moringa, that would be 10 divided by 1,000 to convert to kgs times 300. What do you get? Thank you. 3 rands. So that's 3 rands. Please note that this calculation is for moringa. Right. Okay, maybe let me do this so that when you are trying to see what was happening there, you will be able to see that this is for MB only. Right. That's MR, so I will correct. Then both BF and MR require packaging in the form of hardboard, box paper, and plastic containers as part of the production process at a budgeted cost of 150. Packaging 150. Right. Then we have direct laborers are employed to work in the production process at a budgeted rate of 38 per direct labor clock hour. It takes 6 direct labor clock minutes to produce 1 unit of BF and 9 direct labor clock minutes of MR. Right. We don't want, as long as we're given the okay, here we're given the what? Is it the clock? It takes 6 direct labor clock minutes to produce 1 unit. Right. The labor costs that we include in the cost of our units is not necessarily the clock hours. We include the work hours. There's a difference between work hours and the clock hours. The clock hours is the time that you do the actual production, excluding any idle time. And the work hours is the time that you are at work, including idle time. So our costing of labor should include the idle time. Our costing of labor should include the idle time. So we should convert that to work hours.
But so
Yes.
they're paid per clock hour as well.
I can't hear you.
They're paid per clock hour, not work hour as well.
I
Would
can't
we
hear
still? Can you hear me now?
you. Yes, I can hear you.
But they say they are paid 38 rand per clock hour as well. So would we still include the idle time?
Oh, they pay per clock hour. The rate is per
Yes,
clock
per
hour.
work hour, yeah.
Oh, it's per clock hour. So they are charging. If I had not gone there. So if your labor rate is in work hours, then you have to convert your clock hour to work hours. But here we're given, so we can just multiply directly. Thank you so much. So we can multiply directly here. The 36 times the what? Here is the 6 minutes, and here is the 9 minutes. So we'd say direct labor would say 36 multiplied by, that is 6 minutes, 6 divided by 60 to convert that to hours, since our rate is per hour.
So the budgeted rate is 38, not 36.
38.
Yes.
Then we come here, we say 38 multiplied by what? 9 divided by 60. Four and 6. Did you use the 38 or 36 there?
38.
The 4 and 6. They are correct ones using the or 3.8.
Oh, sorry, mine's rounding.
I'd wrongly put 36 that at that time. I'd used the actual. Remember, we're dealing with the budgeted. And the other one, 5.7. Thank you, guys. Then budgeted in actual variable production overheads are 0.56 and 0.62 per unit. So with variable production overheads, no calculations, they're given. Zero 0.56, 0.62. Right. Two 2.111 is fixed overheads. Then the variable selling costs for both types were 1% of the selling price. We are not interested in the actual variable selling costs. %, multiplied by 14. 1% multiplied by 18. We get 0.14 and 0.1. Is it what? 0.14 and 0.18. Right. So those are all our costs. Then we find our contribution. Thank you, guys. That's very correct. Then we get our contribution per unit. Right. Then we know that our sales mix is 2:1. Then so we calculate our weighted contribution. We use now, that's where we use our sales mix. So weighted contribution, we know that is 2:1. So we say this is 2/3 times 5. Our 3 is coming from a 2 plus 1. Then plus, remember it's 2:1. 1/3 multiplied by 6. What do we get?
$3.33 for the first one.
Can you give me the overall answer? $5.33. So we can say 5.33 here. Let me just put too many decimals to ensure accuracy. Right. So then our break even. Guys, if you use the method of batches, if you are comfortable with that one, it's still okay. You still get the same answer. Your answer will be the same. Right. We know that our total fixed cost, remember that break even is fixed cost over weighted contribution. Our fixed cost is 2 million. And then our contribution is 5.3333. So if we can say 2 million divided by 5.33333, what do we get? $375,000. So we have 375,000 units. That's our break even. Right. Then our breakdown. Now to separate how much remember we've got BF and MR. So BF, we use the sales mix. 2/3 times 375,000. What do we get? No, it's not, but to just ensure accuracy, that's my advice, that you, as long as you're not yet on the final answer, because when you are dealing with millions and you are not yet on the final answer, if you round to 2 decimal places, it might happen that you find that your final answer might be far away from the correct one. So my advice is, if possible, you can, unless specified otherwise, you can use more decimals if you're not yet on the final answer. Right. Then the other one, that's MR 1/3 multiplied by 375,000, which is 125,000. Is that right? Right. That's very correct. If you are using Excel, you can be able to be better. Then we can get our margin of safety. Right now, we can be able to get our final answer. Remember, they said that find the margin of safety for Moringa flavored product type. The Moringa flavored, but the answer, whatever product you use, it will be the same. So it's the MR. We're using the MR. But even if you use BF or the totals, your break even, your margin of safety will not change, considering that we're using the sales mix. So the MR, remember that the budgeted sales are for MR, they are 129,400. So you'd say 129,400 minus the break even that we found above, 125,000 multiplied by 100 over the 129,400. What do you get? %3.4%. So they are living dangerously, because if their sales drop by around 3%, they are in danger. Because it's better if your margin of safety is as big as possible. So their margin of safety is 3.40%. Any questions? Right. Okay. Thank you so much. If you don't have any questions, then I will give you the break. My time is around 14 past, so we should start around. Let's start around half past. Let's start around half past. Let's start around half past 12. So I will give you about a 15-minute break. We'll start around half past. Thank you so much, and God bless you richly. So you can just mute yourselves. I'm not going to go out of the meeting, so I will not. You will not have to use the new link. You just use the same link. Thank you so much, and God bless you. We'll meet in 15 minutes. All right, we're going to continue. All right, we're done with part D. Now we're now on part E. Based on information evident from the scenario, identify and briefly discuss 3 social, ethical, and environmental matters which may affect business operations on the Maheu division. Right. First of all, I think we read that they are. I think I read something about employing. Okay, there was. First of all, there was a social movement organization for employing underage immigrants and paying them a rate that is below the minimum age. Right. So we can say right, they said we should social, ethical, and or environmental matters. Failure adhere to labor laws by employing underage laborers and paying below the minimum age, the minimum wage. Right, this can expose the entity to fines. And leads to questions on the integrity of management. As management, they are supposed to adhere. We expect them to adhere to the laws that are there. So if they fail to adhere to them, then we can be able to question their integrity. Then the other issue that they talked about, let's see if there is any. Is it for the Maheu division? Let's see. Was they said we should have 3. The financial manager. I'm just trying to find if there's any way where we can, so for the sake of time, where we can get something that we can be able to write on this. Two, this distribution is responsible for the production and selling of two. Right. Right, we can talk about on the environment side, one of their primary ingredients is water. Sorry, we can also talk about hardboard, box, paper, and plastic containers. Sorry, I think that can be right. Their packaging uses hardboard box, and plastic containers, which can easily lead to increase the pollution. They should consider using other means or recycling material. Right, I think I can also talk about the other thing that we can talk about. We can talk about the water. One of them primary ingredients is water, and if not used properly, can lead to wastage. They can also consider recycling water. Remember that water that you can use for cleaning, it can also be used for other purposes as long as the detergents that we're using were not harmful to the other process. So we can always use water for different purposes within the organization. So these are some of the three things that we can be able to look at. So because we're not talking about social, ethical, you should know that you can mix these issues and the environmental issues. Right, so you can take any other reasons that you can be able to see, which can also relate to them, to that part. Any questions? Right. Our next question. (1.28). 1.28 is mainly talking about the farming division, because the question that we're dealing with, it specifically mentions the Maheu division. That's why I didn't go to one of the things that were under the farming division. That's the reason why. Right, thank you. But if it was an open question about the company as a whole, you could also go there and talk about that, those issues that relate. It will be linked to the failure to adhere to the laws. Remember that here we're not just talking about risk, we're talking about ethical, environmental, and social factors. Right. The next question: draft the actual statement of profit or loss and other comprehensive income for the banana product, flavored product. So please, guys, we should know that we're just dealing with one product, which is the banana flavored. That's what we're dealing with, which is the BF. For the financial year ended 31 December 2021, assume that the actual fixed administration costs that relate to BF were 377,002. So we have been given an assumption there. Now, you should remember that this company is using the absorption costing. Whenever they ask you to prepare a statement, you should know whether the company is using the absorption or direct costing. You should also know whether they are using the weighted or first in, first out. Because of time, I won't be able to do the both, but maybe you can try later on to try to do the other one. I'll just explain the differences. Right. Actual statements of profit or loss and other comprehensive income. Profit statement here that we don't normally use those other BF. So you should be very careful because sometimes they can ask for the whole company, a BF and MR, or they can just ask for one product. So don't be careful not to waste your time. Maybe doing for both products at the end of the day when they only want one product. So you should be very careful there. Right. So we know that would start with our sales. And remember that we're preparing the actual, not the budgeted. Right. Our sales we are told that the actual units sold were 259,000 of BF. We're only interested in BF. 259,000. And the selling price, actual selling price, the budgeted actual selling price of was 14 for BF. So say 14 multiplied by the actual sales. Remember, it's an actual statement, 259,000. What do we get? 3,626,000. Thank you so much. Right. If we're using absorption costing, we'll have cost of sales. If we're using direct costing, we're going to say less variable cost of sales. Opening inventory. Right. I think we're given the opening inventory when I read this information at the beginning. We're told on 2.12 that the actual opening finished goods inventory as it consisted of 1,200 BF and 600 units of MR. These units were valued at 10 Rand for BF. So that means it's 1,200 units at 10 Rand each. So say 1,200 multiplied by 10, of which we're going to get 12,000. Right. Then we'll have production cost. Right. If you're in an exam, you should already know that. Okay, the year we're using the actual, so we can't go back there. So I was about to be wrong here. But if you had used the actual when we were calculating the contribution earlier on, you can just go there and extract your figures. But now we are now using the actual. Right. Our production cost. Remember that we are using our absorption costing, so it would include both variable and fixed production cost. Right. The primary ingredients for BF, it's 1 per unit, but the actual was 10% higher. And so it was 1 Rand per unit and it was 10% higher. Right. So we would say primary ingredient right, which is 1 Rand per unit multiplied by is 10% higher, 1.1, then multiplied by the units produced. Here we don't use units sold, we use the actual units produced. Right, we're told that the budgeted in actual production was 258,800. 258,800. So you should be very careful that for the production cost, you don't use the sold units, especially when you're dealing with actuals, use the produced units. What do we get? 284,680. Right. Then the actual, okay, then the secondary ingredient for BF are banana and preservatives. The related budgeted actual cost is 2 rand per unit. That's the actual cost. So it's the same as the budgeted. So say secondary ingredients. Someone is saying 287,268. What should I take there? Oh, okay, they've corrected themselves. So okay, that's fine. Okay, sharp. Okay, can you get this one? $517,600. Thank you so much. Right. Then we'll have both BF and MR require packaging in the form of cardboard plastic containers as part of the production process at budgeted cost of 150 per unit. The actual cost was 160. Packaging. 160 multiplied by 258, 800. For 14080. Then the direct labor are employed to work in the production process at a budgeted rate of 38. Remember, the actual was 36, and then the actual direct labor clock minutes per unit was equal to the budgeted. So the minutes were still 6. So I would say direct labor would say 36 times 6 divided by 60 to convert to hours, then multiply by 258, 800. $93,168. Thank you. Budgeted and actual variable production overheads were 56 cents, sorry, per unit. Variable production overheads. $0.56 multiplied by 258, 800. Okay, thank you. $144,928. Because we're using absorption costing, will also include the fixed production overheads. Absorption rate per unit was 150, and the resultant overhead amount is treated as a period cost. That means they don't include it in the cost of sales. So if they say it's a period cost, that means it will be treated as an expense. It will not be included in product cost. Right, so it's 150, and they absorb according to production units. So I would say fixed production overheads that would be 150 multiplied by 258,800. $388,200. Right. I think that's all on the production cost. Or the other non-production cost. Right, my friends. If you were using the difference, if you were using direct costing, in this opening inventory, we're going to take out the portion of the fixed cost. Then in this cost, we're only going to include the above 5. We're not going to include the fixed production overheads. So this fixed production overheads are not going to be included if we're using direct cost, direct costing. So this will give us our production costs. Right. Then we subtract our closing inventory. Alisa,
The fixed production overhead, is it not supposed to be 400,000? I don't understand because it says the actual fixed production overheads that relates to BF.
no,
was
remember that when we are
100,000.
absorbing overheads, we always use the budgeted rate. The actual will then use them
Oh,
to
okay,
determine the over or under
yes.
absorption. So always, when
Yes,
when you are doing the actual statement, when we include our fixed overheads, we always use them include them using the
budget.
budgeted overhead absorption rate.
Okay, all right, thank you.
Thank you, my dear. So the actual overheads will then use them to determine if there's an under or over absorption. And that under over absorption, if they say is part of product cost, we're going to include it here in your cost of sales. But the fact that they say that it's a period cost will not include it in cost of sales, it will be an expense. Right, our closing inventory. How you calculate it depends on whether you are using a FIFO or weighted average method. Right, I would start with weighted average method in case we have weighted average method. But here we're not using the weighted average method. So if you are using the weighted average method, to calculate your closing inventory, you would say opening inventory cost plus current production cost multiplied by closing inventory units divided by opening inventory units. Plus current production units. So that could have been our method if we're using weighted average. So we're going to take this opening inventory cost plus this production cost. We're going to add them in this year. Then divide by the opening inventory units, which were 1,200, plus the production units 258,800. Then we multiply by the closing inventory units. Right, our closing inventory units were not given.
Sorry, so can you just repeat that last part?
I said here at the top, our opening inventory cost plus current production cost was going to be this 12,000 plus the 2681. Then at the bottom, our opening inventory units plus production, we know that our opening inventory was 1,200 units plus the production, the 258,800. That was going to be our denominator here.
Thank you.
Right. Our closing inventory, we know that this is equal to opening inventory. Here I'm talking about units, please, guys, plus production minus sales. Remember, I told you earlier on in our studies that as long as we know 3, we can determine the other one. Right? Our opening inventory is 1,200 here. Right? Plus our production is 258,800. Yeah, they are given on the question. Minus our sales, which is 259,000. So how many units do we have in closing inventory? So as long as we know 3 of these items, we can determine the one that is missing. What do you get? Thank you, guys. 100 or 1,000? Okay, thank you. 1,000 units. So for me to calculate my closing inventory using the FIFO, I would say, okay, yeah, right. We would say our opening inventory is 1,200 plus our current, our opening inventory cost, that's 12,000 plus our current production cost 2,681,168 multiplied by the closing inventory units, which are 1,000. Then I divide by opening inventory units 1,200 plus the production units, which is 258,800. Right, what do we get? $10,358. That is our closing inventory. Right, so if it was so this will be weighted average, is that right? So let me not put this here. Remember that we're not using the weighted average, remember. So this was going to be our inventory for using the weighted average. So whether you're using weighted average or FIFO, this will be the only difference. Everything else will be the different, it will be the same. The other difference maybe will be the valuation of this opening inventory. It will also be different. Because when we use a weighted average, it might have different weights from last year. But if it's given the opening inventory, the only difference between weighted average and first in will be the closing inventory. Everything else will be the same. So this one is not our answer, guys. Why? Because this question is using FIFO. Now, when we use FIFO to calculate your closing inventory, instead we say current production cost times a closing inventory units divided by the current production units. So the difference with FIFO and weighted average method is that we just get rid of the opening inventory. We don't include the opening inventory in our calculation. That's the difference. Because the assumption of first in first, why? Because when we're using first in first out, we assume that the first units to be produced are the first to be sold. So our closing inventory is entirely made of goods produced this year. That's why we don't include the opening inventory in the calculation of closing inventory. So they will be based entirely on the cost structure of this year. Why? Because we are assuming that the opening inventory was already sold, so it's no longer in stock. So we don't need to incorporate it in the calculation of our closing inventory. That's the reason why. So here would just say 2681 168 multiplied by 1,000 divided by 258,800. What do we get? 1036. Right. So here would get negative 1036. Right. Then we'll get our cost of sales. Which will be the opening inventory plus the production plus minus the closing inventory. Right. Then we'll get our gross profit. In direct costing, we don't have gross profit. In direct costing, otherwise we're going to get a figure here, and then we're going to go further and subtract the other selling variable costs to determine our contribution. We're going to determine our contribution if we're using the direct costing. Right. Then less expenses. Then my sister was asking, that's where we then check now if we've gotten over or under absorption. Right, we absorbed 388,200 as our fixed cost, but we were told that the actual fixed cost that relate to BFO 400. So that was an under absorption. We absorbed, if you absorb less overheads than the actual, there's an under absorption. So you have to add to the expenses. So we have under absorption.
Sorry, so can you just click on that cost of sales? I just want to see the formula that you used there,
Okay.
because mine isn't agreeing. I don't have my fingers or.
Right, you should be very careful that here I said plus instead of minus. Why? Because it's already negative here. So if I say minus, it will add. So I think, are you sorted?
No, I don't know why mine is wrong. It's
Can you say negative just before? There's a negative here, then there's.
okay. Let me check. Okay, thanks.
I sorted.
Yes, thanks.
Okay. So there's an under absorption here, which we are going to say 400,000 minus the 388,200, which we absorbed. What do you get? $11,800. Please note that I've included it here because they said that we can treat it as a period cost. But if it was a product cost, we're going to include it here in the before determining this cost of sales. It was going to be added here, then would add it to the cost of sales. If it's a product cost, your under or over absorption will be part of the cost of sales. If it's a product cost, but if it's a period, that's when we take it out like this. Right. Sometimes they even take it out before the gross profit. They can just subtract it as a separate item, but they don't include it in cost of sales. That's the issue. Right. And if you're using direct costing, there is no over or under absorption. In direct costing, these fixed overheads, we're going to include them at 400 straight under the fixed cost. Right. Then we have got other non-manufacturing expenses who also feature here. Right. If we still remember that there was a variable selling cost, which was 1% of selling price. The actual was, however, 1.5% of the selling price. Remember, we're doing the actual. So say variable selling costs. (1.5% times the sales), 3,626,000. What do we get? Thank you. We're going to say 54,390.
Mr. Eugene,
Yes.
just check there where your multiply must be, there's an 8.
Oh, thank you so much. It is a typo. When I put second function, it couldn't. Thank you so much. That can confuse someone when they get the answer. Or maybe they are not in class, then they will struggle. What is happening with the 8? Thank you so much. Right. Then we also have fixed administrative costs. Now, remember these ones were for both products, but on the required, they informed us that we should assume that the fixed administrative cost is 377,002. Fixed administrative costs.
Oh.
377. Right. And please note that if it was an over absorption, it was going to reduce our cost. If this was an over absorption, let's say they had absorbed more than 400,000, instead of adding to the cost, it was going to reduce the cost.
Sorry,
Right.
so where did you get that 377.002?
It's given on the required. They said here, where I highlighted here.
Oh, okay, okay.
Right. Then we get our net profit. Oh, I didn't add the expenses. First of all, we need to add our expenses. Then we get our net profit. That is our net profit, 500,000. So that's a absorption costing profit statement.
So if it
Any
was,
questions?
if it were direct costing, we wouldn't have included the under or over absorption.
Yes, we don't have under over absorption, but rather we would have included here. We were not going to have fixed overheads.
Yes.
We're only going to have fixed overheads here, and they're going to be included at 400,000 straight. And it was not going to be expenses, it was going to be less variable costs after getting our contribution. Less fixed costs, sorry. Less fixed costs. Any questions? Right. So please, you can just try the other one so that you can see how to do that. Let's go to number G. Assuming that a standard costing system is in place, calculate the following variances Number one, the total purchase price variance for primary ingredients of BF only. Right. Purchase price variance. Standard price minus actual price multiplied by actual quantity purchased. Right. And you should know which product that they are talking about. They are talking about the primary ingredients for BF only. Right. BF, the primary ingredients used in the production of both BF and MR, we're only talking about BF. The budgeted combined cost of the aforementioned ingredient were R1 per unit, whereas the actual combined costs were 10% higher than budgeted costs. The budgeted and actual usage quantities were the same as at 0.8 kgs per unit. Is that right? Right. So we're saying our standard price is equal to, we know that this price of R1 is for 0.8 kgs because each unit was using 0.8. So our standard price would be equal to 1 divided by 0.8. What do you get? That means it's R1.25 per kg. So they are buying at R1.25 per kg. And that was supposed to be the standard price. But then the actual price, they said it was what? 10% higher. When the quantities were the same. So it was 10% higher when the quantities were the same. So that definitely means the price was 10% higher. So the actual price would be equal to 1.25 multiplied by 1.1 to make it 10% higher. What do you get? $1.38. Can you just put it at 1.375? Is that correct? The actual, to just avoid a difference, a rounding, a difference error, right? Then our actual quantity, they said the actual quantity was according to the budget, so they were using 0.8 per unit. And remember that they were producing 258,800, right? Another thing, you should know that we're talking about a raw material here. So in this particular question, there is no way that we're told that they are keeping inventory of raw material. So we would easily assume that for the ingredients, there's no opening or closing inventory. So we would say that the ones that they require for production will be exactly equal to the purchases. But if they told us that the actual units quantity purchased, remember that the quantity purchased can be different from the one that is used in production if the company is keeping inventories. But if there are no inventories, the quantity used will be exactly the same as the quantity purchased. So that's why we just send to production. We know that it's 0.8 per unit and they produced 258,800. So we multiply by 258,800. So we'd say actual quantity is equal to 258,800 multiplied by 0.8 because each requires 0.8. Right. What do we get? $207,040. So we'd say our standard quantity, our standard price, which is 1.25, minus our actual price, which is 1.375, multiply by 207,040. But please, if they are keeping raw material inventory, please, you don't just use the production. You have to use the actual purchase. Right. What do we get? Thank you. That's 25,880. Let's not forget to put a U when we're doing variances. We should always remember to put a U for unfavorable, because this was unfavorable because they paid more. Right. Any questions there?
So if I don't use the 0.8 kilograms in any of the in any of them, I still get the same answer.
Yes, you can get the same answer also. You can use the units.
Okay.
If you don't
Is that
put
right?
U minus,
You can
You
just
use
say 1 minus 1 rand 10 cents times the 258,800.
Yeah.
if you don't put
That can
the
be
U,
correct. But I just did it for the standard so that in any, because you'd find that in some questions that might not apply per se. You might not be given per unit. So that's why I just wanted to use the standard way so that
Okay.
even if it comes in a different way, you can easily apply it.
I see. Okay, thanks.
Right.
oh, sorry, Eugene, if you don't put the U and you just have it as a minus, you need to say at least unfavorable.
Normally, they want you to say either it's favorable or unfavorable. The U
Okay.
can also be replaced with an A for adverse. That's the standard that we normally expect. So please try by all means to do it. Right. Then the next thing, secondary ingredients, a moringa powder usage variance. Right. Secondary ingredients. MR variance. Usage variance. That is the standard quantity minus actual quantity multiplied by the standard price. Right. So this is a variance that arises because we used more than what we have used. Right. This a secondary ingredient for the MRI is moringa powder. The budgeted and actual usage of the moringa powder per unit was 10 grams and 12 grams, respectively. Remember that actual and budgeted production were the same. So these were for these units here. The division budgeted and actually purchased the moringa powder at 300 per kg. This is the standard price, right? So we can say our standard quantity would be equal to, they were expecting to use 10 grams. We can just divide that by 1,000 to convert it to kgs. Apply by the number of units that they produced, which were 129,400. What do we get? Remember, actual production and the budgeted production were the same. Thank you. Right. One, 2, 9, 4. Then the actual quantity, instead of 10, they use the 12 per unit. Remember, budgeted and actual production were the same. What do we get? Yeah, 1552.8. Right. Then we can input our parameters into our formula. So then we can say our standard quantity is 1294 minus 1552.80 multiplied by the standard price, which is 300 were given. What do we get? $77,640 unfavorable. Thank you. Right, so I'm not going into the reasons. I think we discussed them over the past 2 years, still fresh with them. So that means they used more than what they were expecting. Then next, the direct labor idle time variance. Direct labor idle time variance. Standard idle time minus actual idle time multiplied by the work hour rate. Standard work hour rate. Right. The standard idle time allowed, the standard is the allowed idle time, which is 5%. When we say when you see standard in allowed idle time is 5%. So, but when you are calculating your standard idle time, you calculate it on the actual hours spent on the work. Right. Our question wants us to calculate per product type and in total. Per product type and in total. Right. So we'd say product standard idle time actual idle time. Difference. Standard rates. And variance. Right. BF MR. Right. First of all, let's determine the actual hours. When you are determining your idle time, your allowed idle time, and your actual idle time, you determine them on the actual hours spent, not on the budgeted hours spent. Right. The actual direct labor clock minutes per unit was equal to the budgeted. So they were the same as budgeted. They were 6 and 9. And remember that our units were 258. We use the production, not the sales, because the direct labor is indicated in the production. 258, 800, and 129, 400. So we'd say BF is equal to 6 divided by 60 multiplied by 258, 800. What do we get? Right, we get 2588. We get then MR. We know that MR is 9 minutes multiplied by the produced units, which are 129, 400. What do we get? 19,410. Right. Then we'd have our standard idle time. Remember that it's 5%. So that means BF would be equal to 5% multiplied by 25,880. What do we get? $1,294. Then MR would say 5% multiplied by 19,410. What do we get? $970.50. So this means 1,294, 970.5. These are hours, is that right? Then we'll have our actual idle time. Right, we're told that the actual idle time was 8%. So it's 8%. So Dev BF 8% multiplied by 25880. What do you get? That looks too big, that figure. To 070.4. Right, then MR 8% multiplied by 19410. Uh, 1552.80. Right. So would say to 070.4, we have 1552.8. Our difference is simply the difference between the two figures, which is this minus that. Right. Then our standard rate, standard work hour rate, is equal to standard clock hour rate divided by 1 minus idle time percentage. Standard idle time percentage. So we know that our clock hour rate, so you should make sure that you use your work hour rate. Our standard, we use the standard clock hour rate was 38. So it's saying 38 divided by 1 minus 5%. What do you get? So that's 40 per direct labor hour. Waking hour. So here we'll have 40. Right, can you multiply this one times 40? We have 23292, 31056. I'm coming to you unfavorable. And 23292. Unfavorable. Then we get our total. What do we get? 54384 unfavorable. There was someone with a question. I think whilst we were doing these calculations, was raising a hand.
Yes, Eugene. Yes, Eugene, it was me. I'm a bit confused on the calculation for standard hour rate, whereby we said 38 divided by 1, less 5%. Where did you get that?
The standard
One-
idle time, which were given on the question.
Yeah. Okay, I get that at 8. Then the 1.
No, the standard here it's 5% here.
Okay.
Can you
One
see?
word. Yeah, I
One
get
is
the
for
5.
100%. It's the standard. It represents 100%. 100% is equal to 1.
Oh, okay. Okay.
1 is our standard.
Okay.
Right. 54348. Okay. Right. So that's it on the on that variance. Right. We go to the any other questions there? No questions. So go to the next question. Right. Identify and briefly discuss 2 possible reasons for an unfavorable purchase price variance. Right. A unfavorable purchase price variance can result from various reasons. Right. It can be a because we used a different supplier. It can be because of inflation beyond expectations. It can be because of purchase of better quality material. It can be because of certain market changes, pushing up prices. For example, shortage of material on the market. Right, so those are examples. Setting a realistic budget, you can always find other reasons there. Right. Then regarding the divisions 2022 financial year, a budget information and the related workings presented by the financial manager draft report, wherein you identify any 4 principal errors in the provided information and the related working papers. Furthermore, provide a reason why you deem each identified error to be a principal error. Provide all the correct workings where applicable. Right. They are for the 2022 financial year. they say that during the division's planning session for the 2022 financial year, the financial manager presented the following budgeted information and the related working papers regarding the optimization of the constraint or available production resource. That is the limiting factor. The division budgeted to produce and sell 260,000 and 130,000 MRs. The direct labor clock hours per unit will be equal to that of the 2021 financial year budget. That means the 6 minutes and the 9 minutes, and the maize requirement is 0.5 kg per unit. The variable selling cost per unit will be 0.50 per unit for both product types. The financial manager also presented a summary of the detailed calculations performed for the optimization. Right, the required resources, maize, they said 130 here, MR 65. If you can go, we know that they need 0.5 kgs. So if you say 260 times 0.5, you get truly that is 130. Then the 130 times 0.5, you actually get the 65. Is that right? Then they said available, it's 132 and 66. Then there's a surplus of 2,000 and 1,000. Is that right? So maize is not a limiting factor. I think there's no problem there. Is there a problem there? I don't see any problem there. Right. So we here, but if they say perform a critical analysis, you normally analyze both correct and what wrong things. But here now, we are not interested in they said what principal errors. Right, on the direct labor hours, they required, they said 26. You can also check. This is 260. Each unit requires 6 minutes. So we can just simply calculate. Can you just I think it gives us the 26,000. That would be correct. I don't want to waste time here. Then the 130,000, if we say 130,000 times 9 divided by 60, it will give us the 19,500. So I think that is fine also. The 26 and the 19, they are correct. Remember that each BF requires 6 minutes. Each MR requires 9 minutes. So we simply multiply by the minutes, divide by 60 to convert to hours. So there will be no problems here. So 26,000 plus 19,500, we get 45,500. The available is 40. So direct labor hours are a limiting factor. That is correct. Right. Now they say application for linear programming. They say 0.50 BF plus 0.50 MR is less than or equal to 198,000, which is correct. This is 198. Then they have 0.10 BF plus 0.15 MR is less than or equal to 40,000 hours, which is very correct. 0.10 is coming from 6 minutes divided by 6. That's 0.1. Then the 0.15 is coming from 9 minutes. 9 divided by 60 is 0.15. Right. Now our issue maybe becomes here. We might have principal errors. Right. Number one, when we've got a limiting factor, we don't deduct fixed production overheads. Right. So number I, the fixed costs were deducted in calculating contribution. Whereas contribution is supposed to be selling price minus variable cost. But as you can see, they only deducted the variable production cost there. Right. Then number 2, this variable selling cost was not subtracted. That's number 2 error. The variable selling costs were not deducted in determining the contribution for the reasons that I stated above there. They are supposed to be they are a variable cost which should also be deducted when determining contribution. Right. Then the next thing, the ranking. They used the contribution to determine the ranking, but they are supposed to use the contribution per limiting factor. The ranking was determined using the contribution per unit. Instead of using the contribution per limiting factor. Right. Then what other error can we're going to do the calculations, because they said that we should also incorporate the calculations. Let's see if there is any other principal errors. I don't see any other thing. Do you see any other thing here?
They didn't include the allocation, but I don't know if that falls under that last answer.
Which allocation?
Well, how it's going to be allocated if there's units left after the limiting factor for the second product.
Okay, yeah, they have to. Let's see. And regarding the optimization of the available. But I don't think that we should include that one for now.
Let's say, for instance, you need the available resource is 40,000 hours. You need 35,000 hours for the one product, and then
Yes, I understand that. I understand what you're saying. That to determine how you allocate those 40,000 hours. Is that right?
Yes.
But here, regarding the divisions budget and the related workings, identify any 4 principal errors in the provided information and the related working papers.
Oh, and
so
it's
we
not
need
provided,
to comment
so
on what is provided there.
Okay. In the application of linear programming, it says the direct labor clock hours 10 BF plus 15 MR is less than 40,000 hours, but that is more than 40,000 hours. It's
You said the direct labor hours are what?
the direct labor hours, the 10 BF plus 15 BF. It says it's less than 40,000 hours, but if you look at the calculation above the required resources, that's 45,000.
No, when we are using linear programming, we use the limit. So they're
Yeah.
supposed to be less than or equal to the 40,000, the available resources. So that
Okay.
is very correct.
Oh, okay.
So we'll be saying that these labor hours should be less than or equal to 40,000, the actual ones that we're going to apply. So that part is very, very correct. Because they wanted 3, but I don't think I see any other third one here. Unless if you are just saying, but you'll be repeating that they subtracted total production costs instead of subtracting. Maybe we can just say they deducted total production costs, but we should deduct only variable costs. But I feel that this one is just almost the same, unless if they wanted it to be separate with this one here. Right. So now they said we should provide calculations. Now when we do our calculations, Nonkululeko,
Where are they getting their selling price on that table, the optimization?
they are giving you. That's the price that we should use for now. So they are giving you that the price is. So the question is not on the necessarily on the figures. Our assumption is that all those figures are okay.
So that's the principle. Okay.
Yes, that's what we are saying here, because they didn't give us anywhere else that information.
Okay.
Right. So we'll now say our selling price $15.19. Right. Then we have what? Less variable cost. Variable production cost. We have 11 and 14. Variable selling costs. Rand per unit, 50 cents per unit. So they have right.
Would we not include the labor hours,
The what?
the labor cost?
This is variable production costs. So
Is
our
that
assumption is
included?
that all the costs are included there.
Okay.
Remember, this is for 2022. What we're dealing with was 2021.
Yes, but they say the clock hours is equal to that of 2021.
Yes,
labor
that is the time, not the amount. But these ones are not variable materials or variable what? These are variable production costs.
Okay.
That means it includes the material, it includes the labor.
Okay.
You should see that this is not variable production overheads. No. Variable production costs. That means it includes direct material, direct labor, variable overheads, all of them together. Right. Then we get what? Our contribution. Right. Then we should have our direct labor hours required. Which were also given. Yeah. 0.10 and 0.15. But you remember that it's the 6 minutes. They said it's the same as the last year. So it's the 6 minutes. So if you can just divide by 60, that's how you get this 0.1 and 0.15. Right. Then we get our contribution. Okay. Direct labor hour. So we don't just use the contribution. They ended on the contribution, but you are supposed to find the contribution per that resource that is a limiting production. So if the resource that was in short supply was the maize, we're going to find the contribution per kg of maize. Right. So here to get this one, you would say 350 divided by 0.1. Then we'd say 450 divided by 0.15. Right. Then we can get here this divided by this. So that means each hour that we spend on BF is bringing in 35 rand to the company. Each hour that we spend on MR is bringing in 30 rand. So then we would then do our ranking from highest to lowest. Number 1 and number 2. So that means we should first allocate to BF, then to MR. If they wanted you to finish off, then you could simply say BF should be given the 26,000 hours. MR should only have 19,500. So BF will produce all the units required, but MR will then have to say 19,500 divided by 0.15 to find the number of units that could be produced. So that will be our answer in this case. Do we have any questions?
Can you please go back to the calculation there, the last one? So the one that has the highest contribution gets first preference.
Yes, because that's the most profitable. It's giving us 35 rand per, although it gives us a contribution per unit of 350, but in an hour it brings in 35 rand.
Okay.
Right. Those who are writing tomorrow, I wish you all the best. Please try what you can, get organized. This paper sometimes you fail to finish because you are not organized. Make sure that you try to plan your things accordingly. Make sure that you do those things that you know best first, so that in case time beats you, then you'll be fine. And those who are doing MAC3701, you can use this to just refresh yourself and prepare for what is to come. Thank you so much, and God bless you richly. Have a blessed weekend.
Thank you, Eugene. Have a lovely Sunday.
Thank you so much, guys.
Thank you. Thank you, Eugene. Eugene, when can we expect the recording?
I want to make sure that before I start the next class, I've got a class at 3. I want to do it
Oh.
before then.
Thank you so much.
Sharp.